name is Adam Sweet. I'm a principal with our National Tax Office. I sit in Spokane, and my focus is on pass-through entities, partnerships, and S corporations. I'm joined today by Mel Schwartz, who sits in DC and is director of our Tax Legislative Affairs group. And then also my fellow partner in our National Tax Office, Andrea Mao. She's also a principal. Her focus is on accounting methods, and she sits in Minneapolis. So we thought today what we would do is, we're 2 years now, December 2017 was the passage of tax reform, and maybe give an update 2 years in, and especially as we face the 2019 filing season ramping up, where are we with tax reform? What are the issues we're seeing? What are the unknown issues out there that we're still working through? So from the federal perspective, Andrea's gonna focus on accounting methods, updates to bonus depreciation, the new revenue recognition standards, and also the interest expense limitations under 163J. And then for myself, I'm going to focus on 199A, which is the pass-through deduction. What are we seeing this year for the 2019 filing season? What have we seen from the IRS? And then also the opportunity zone provisions, not so much having to do directly with the filing season, but still very much in the news. And we have a lot of clients still interested and still calling us to find out what is the opportunity zone program and how can they make use of it. And then finally, I think at the end, we'll have Mel to give us a wrap up on what's going on in Congress right now. Will there be other tax legislation? We'll see. Will there be other updates? What's on the horizon in terms of DC? So just in terms of background first, when we talk tax reform, I think it's always important to emphasize that what was passed in December of 2017 was the largest single piece of tax legislation in over 30 years. The last kind of rewrite of the tax code was the Tax Reform Act of 1986. And when we talk broad tax reform, when we use the term broad, the reason why we use that is because what was passed in 2017 touched on every single topic or every single facet of the code. So it started with the corporate tax rate was reduced to 21%. I always say this was a given. The 21% rate wasn't a given, but everyone knew the corporate rate was going to be cut. There had been rumblings over the last 5 or 6 years about the anti-competitive US corporate tax rate. It ran to a high of 35% under prior law. It was graduated, so not every corporation paid 35%. But still, the headliner then with the 2017 Tax Act was indeed a flat 21% corporate tax rate. So mission accomplished there, at least in terms of Congress. And then on my side of things, I don't do so much of the corporate work, but I do a lot of work with pass-through businesses where owners are paying tax on their business income. It's 90% of America and probably 99% of Eide Bailly's clientele. So the question there was what was going to happen to those businesses because they can't benefit from the 21% corporate rate. So what we got was new Section 199A, which we'll talk about a little bit later, that provides a 20% deduction for owners of pass-through businesses. It can effectively lower your rate from a high of 37% down to a rate of about 29.6% if you can fully make use of the deduction. Also of note, we're not going to talk about it so much today, but there were also very large international tax provisions. The way that multinational corporations and multinational businesses, how they are taxed. There were large changes there. Again, we're not going to cover that today. We don't have enough time. But Eide Bailly has insights out there. We also have a large international tax group as part of our National Tax Office, so that if anyone is interested, please reach out. Also so we had the corporate rate cut. We had the 20% 199A deduction. We had individual rates, by and large, were all reduced. That we have less, the rates were reduced and the standard deduction was increased. We also had expanded investment incentives brought through with the Tax Act of 17. Opportunity zones is one provision. Another provision that Andrea will be talking about here is 100% expensing. I think that certainly encourages capital investment. Whether that will be maintained in the coming years, we'll see, but certainly encourage lots of people to make capital investments this year. Small business simplification, I put simplification, I probably should have put it in quotes because it's not always as simple as it seems, but They expanded. Traditionally, there was a gross income cutoff for quote unquote what it means to be a small business. They brought that up to $25 million so that small businesses that have gross receipts of 25 million or under can avoid many of the limitations and perhaps avoid many of the rules that were put in place in 2017. And better bonus, we have 100% expensing. Unfortunately, in certain circumstances, we have an accelerated recognition of income as part of tax reform, and then also limits on business interest expense. Those last two I sometimes call pay-fors, that they had to make some attempt. They certainly didn't, they being Congress, did not balance tax reform, but they had to bring in some revenue raisers with tax reform. And I think those last two bullet points are examples of revenue raisers. But I know Andrea is going to cover both of those items more in depth. So I think with that, I'll turn it over to Andrea.
Great. Thanks, Adam. Well, as Adam mentioned, there was some good news and some bad news in tax reform. Specifically on the method side, we saw some good things and some bad things. The good news, as Adam said, the increased bonus depreciation to 100%. The Section 179 expensing, they left the broader real estate property exceptions in there, increased the threshold, both for the deduction and the limitation when the investment limitation kicks in to start reducing your deduction. And from a simplification perspective, they did increase the gross receipt safe harbor, as Adam said, that allows more taxpayers to qualify to use simplified accounting methods or at least avoid application of some of the more complex rules in the methods world. However, that was balanced by some bad news. We had a number of deductions that were either reduced or eliminated in connection with tax reform. DPAD, the old Section 199 domestic manufacturing deduction, was replaced in part by the 199A deduction. Adam's going to talk about later. Fines and penalties. There are now significant limitations on what is considered a fine and penalty and is not deductible for tax purposes. In the meals and entertainment space, entertainment is now fully non-deductible. More of the meals that used to be 100% deductible have moved to a 50% threshold, and some of those 50% meals are scheduled to go to zero in a couple years. The interest expense limits under 163J, as Adam alluded to, we'll talk about those in a couple minutes. There are also some limitations placed on the use of net operating losses to offset income, and for the first time, there is a limitation on the use of losses from pass-through businesses. Even active businesses can be limited in their ability to use those losses to offset non-business income. And also, we saw some negatives on the revenue side. As Adam alluded to, we have some new revenue recognition provisions under Section 451 we'll talk about in a few minutes that for some of our clients are resulting in a significant acceleration of when that revenue needs to be recognized, and also some modifications to how they're handling deferred revenue. So where are we sitting right now in terms of tax reform? This is, as Adam alluded to, we're more than 2 years out, and we have received a lot of guidance from the IRS. We've received a lot of proposed regulations, final regulations, revenue procedures, revenue rulings, notices, the whole gamut. We've seen everything come from the IRS. The American Bar Association tax meeting was the end of January, so about 2 weeks ago. And the IRS Chief Counsel announced publicly at that meeting that the IRS believed they have 100 guidance projects remaining to implement the TCJA, and their goal, as prescribed by Treasury, is that those regulations must be out, or that guidance must be issued during calendar year 2020. So for those of you who thought we were drowning in paper and drowning in rules already, we are not. There is a lot more coming, and a lot that the IRS has on their radar. And we were informed by the Chief Counsel for the Income Tax and Accounting Branch at the IRS that 25 of those 100 projects are projected to be accounting methods related. So a lot of the issues we talked about on the prior slide, some of them have been addressed, some have not been addressed at all. We're looking for finalization of some of that guidance, as well as first rounds of guidance on a lot of those issues. So there's going to be a lot of activity and a lot of things shifting over the course of this calendar year. Hopefully the IRS can hit their goal and get all this out by the end of 2020, but I'm afraid that could be a very ambitious goal considering what they view as their to-do list on that. So bonus depreciation, as we said, the headlines here, bonus was increased from 50% to 100%. This was effective for assets that were both acquired and placed in service after September 27, 2017. So this particular provision had a different effective date. The rest of the TCJA rules largely came into play on January 1 of 2018. So we did get some pre-2018 benefit here. For the first time ever, used property is eligible for bonus depreciation. Historically, bonus depreciation had only been allowed for new or original use property. Now, used property is eligible, which has raised a lot of questions on how that applies. And this also interacts with the interest expense limits under 163J. There are some exceptions to 163J that taxpayers can either choose to take advantage of or are required to take advantage of, with the impact that it reduces their depreciation and slows down their recovery periods. And thus far from the IRS, we have received several pieces of bonus-related guidance. We had proposed regulations issued in, I believe it was August of 2018. Those regulations were finalized in September of last year, and we also got a new set of proposed regulations last September. And the good news for a lot of taxpayers is that in many ways, the final regulations and new proposed regs that came out in 2019 were more taxpayer favorable than what was included in the 2018 proposed regulations, which, as we'll talk about in a second, has created some potential opportunities for us. So where are we seeing with the questions we're getting right now related to bonus depreciation are largely focused on the tax year that included September 27, 2017, and then potentially into the 2018 tax year. What we're seeing there is that people are looking back at those years for any assets where they did not take 100% bonus. We're reanalyzing that to see if there's an opportunity to qualify for those for bonus. As I alluded to, the property to be eligible for 100% bonus had to be both acquired and placed in service after September 27. And the prior proposed regulations from 2018 set that acquisition date earlier than a lot of people had anticipated the rule would be. And the 2019 regs pushed that date back. And what that means is that allowed some assets that where construction had begun to qualify for 100% bonus. So right now we have a lot of taxpayers looking back at those returns to see if there are any additional opportunities. There was also a new component election included in the proposed regs from 2019 that would allow certain pieces of larger property to be 100% bonus eligible, even if the larger property itself was not eligible for bonus depreciation. We're also getting a lot of questions on the overlap of this and 163J. So 163J does not apply to regulated utilities, but the trade-off is regulated utilities don't get to claim bonus depreciation. Similarly, taxpayers that have taken into account floor plan financing interest in determining their 163J interest expense limitation are banned from taking bonus depreciation. Taxpayers who are engaged in a real estate trader business or an agriculture trader business can potentially elect out of 163J, but in that case, they have to use the alternative depreciation system. So we're getting a lot of questions on how those rules interact, how do those calculations work, am I subject to those limits, am I not, should I make elections, should I not? There's a lot of thinking going on there in terms of what is the better answer for my business. Is it interest or is it depreciation? And one of the biggest things that the used property qualification opened for us is the ability for certain transactions to be eligible for bonus depreciation, so certain asset acquisitions. The portion of those purchase prices that are allocated to fixed assets, tangible property assets otherwise eligible for bonus, can be immediately deducted. But there are a lot of nuances in the transaction space, specifically in the partnership space, and whether some of those transactions truly qualify and meet the used property requirements, or whether they run afoul of some of those limitations on purchase price and things like that. So there's still a lot of movement and a lot of questions being asked in that space, and we're hoping to get a little more clarity for the IRS, but unfortunately those can be very complicated issues. And the big issue for us from a timing perspective is if we do have a situation where a taxpayer would be eligible to take more bonus than they did, we cannot request that on existing automatic accounting method changes. And so we need some procedural guidance from the IRS letting us know how we can go back and adjust that bonus depreciation that was claimed. And the IRS is working on that. They informed us again a couple weeks ago at the Bar Association meeting that they're hopeful that that will be out between June and July of this year. So what we're encouraging our clients to do is if you think there's a possibility that you need to increase or decrease your bonus claimed in prior years, extend those returns, because we should have an answer and should be able to address that by the time the extended return due date rolls around in September.
And Andrew, we had a question.
Okay.
Sorry to interrupt, but from the audience, the question is, are tenant improvements subject to the 100%, I'm assuming bonus, lessee perspective versus landlord perspective for tenant improvements?
The issue there is there was a drafting error in the tax reform legislation. The IRS intended to eliminate the categories of qualified leasehold improvement property, qualified retail improvement, and qualified restaurant property. Those were all 15-year depreciation asset classes that existed under prior law. The IRS's or Congress's intention was to consolidate those into a single category of qualified improvement property and then assign that category a 15-year recovery period. However, they kind of sort of forgot to actually put that in the rule. So does not exist under the law. It will require a technical correction in order for that to be 15-year property and bonus eligible. And at this point, I don't know that there is a significant likelihood of a technical correction in the near future. So unfortunately, there are some significant limitations on taking building improvements for bonus depreciation currently, and may very well be for a while. All right, moving on to the small taxpayer safe harbors. As Adam alluded to, the definition of a small taxpayer was adjusted beginning in the 2018 tax year. The $10 million threshold that was set back in 1987 or 86 when the 86 Act was passed was never indexed for inflation, and a small taxpayer at that point was below 10 million, and a lot has changed since 1986. At least I'm told that there's quite a bit of inflation that has happened since then. And so this was the IRS's or Congress's attempt to put that better in line with what is actually a small business in 2018, 2019, and that is indexed for inflation. So it was 25 million for 2018 and 26 million for 2019. And one of the big benefits here, if you do qualify as a small taxpayer, is you can use the several simplified accounting methods. You can use the overall cash method rather than an accrual. You can avoid the uniform capitalization rules under 263 Cap A, and then some of the more complicated inventory accounting rules, and also avoid applying the percentage of completion method for long-term contracts. In order to take advantage of these safe harbors, taxpayers were required to file a Form 3115 or an application for change in accounting method. And most of these changes, all of the changes with the exception of the long-term contract percentage of completion change, were made with the Section 481A adjustment, so generated a significant first-year tax benefit by taking advantage, by filing the 3115 to move to those methods. And the IRS did do us a favor here by waiving a limitation on the 3115 filings. Typically, we cannot request the same automatic accounting method change more than once in a 5-year period. Once we've done it, we have to either wait out our 5 years or file a non-automatic change. They waived that limitation for the 2018, 19, and 20 tax years. So that means even if you change from accrual, from cash to accrual last year or 2 years ago, you can still file the 3115 to go back to cash. You can still change your unit count method even if you've changed that within the last few years. So that's something to keep. It's still an opportunity, and even if you tried to implement the safe harbors last year, didn't quite get it right, don't think you quite understood what changes got made, we can refile those 3115s for the 2019 filing season. And then as Adam alluded to, the small taxpayers also avoid the 163J interest expense limits, which has been significant for a number of our clients. But unfortunately, this is not without concerns. We've gotten a lot of questions on several issues specifically related to the small taxpayer safe harbors. The first one being the aggregation rules. So to determine if you are a small taxpayer, if your gross receipts are below the $26 million, you need to take into account the gross receipts of all taxpayers that are under common control. And that's defined by reference to Section 52 and Section 414, which if you haven't looked at those sections before, that would put you on par with 95% of tax practitioners who never looked at those rules before. And that definition can be complicated. There are 50% thresholds, there are 80% thresholds, there are attribution rules, modifications of attribution rules, and walking through that for similarly controlled entities has been challenged for a lot of our clients, but is necessary in order to prove that you qualify for the small taxpayer safe harbor. One of the other caveats in the small taxpayer definition, which is taken from Code Section 448, is that taxpayers that are considered tax shelters cannot be small taxpayers, even if their receipts are below $26 million. And the definition of a tax shelter for this purpose is quite a bit broader than most people think of. These are not just the offshore illegal tax shelters. This is anyone who is allocated more than 35% of losses to limited partners or limited entrepreneurs. And the obvious question there is, well, what is a limited partner and what is a limited entrepreneur? And technically, we have no actual definition of either of those words. Typically, what we're looking for are people that are not engaged in the business in any aspect of management, operations, oversight at all. Those are the kind of people that if they own more than 35%, that entity is not eligible to be a small business, even if their gross receipts are below the $26 million threshold. There's also some uncertainty specifically in the area of the inventory safe harbor as to what methods might be appropriate. There is a reference in Code Section 471 for taxpayers without an audited financial statement to use their quote-unquote accounting policies. And again, I don't really know what an accounting policy is. It doesn't really exist anywhere else in the code, and we don't know precisely what the limits of those policies might be. So we're struggling a little bit for some of our clients on how aggressive they want to be in applying that safe harbor, knowing that there is uncertainty as to how far they can go in deducting their inventory items. This is one of the projects that I know the IRS is working on in the accounting methods area. I don't know precisely what the scope of it is. We're hoping that they address these type of issues, the aggregation, the tax shelter, the inventory issues, but so far they've been pretty quiet on what they're covering in that project. But again, fingers crossed that we'll have that by later this year and hopefully have a little more guidance on how we should be moving forward with this. Revenue recognition, this is another one of those downsides, so to speak, of tax reform. And we've got three developments that are overlapping right now and impacting a large number of our clients. ASC 606, this is actually a GAAP standard, a GAAP IFRS financial accounting standard that changes the rules for revenue recognition for most taxpayers, most clients. Most businesses, aside from a very small number that are excluded, are subject to ASC 606 if they maintain either GAAP or IFRS compliant financial statements. And we are seeing that some of our clients are having to make changes to their book revenue recognition methods in order to properly apply this standard. And that trickles down to us on the tax side because we need to know if that book method is permissible for tax purposes. And if it's not, we now have a new Schedule M or book tax adjustment that needs to be made. Section 451B, this is the AFS conformity rule, as some people refer to it. This is the requirement that a taxpayer with an audited financial statement cannot delay the recognition of income for tax purposes later than it is recognized for book purposes. And this is, unfortunately, it is always if you are subject to 451B, it is bad news. There is no way in which this can be favorable from a tax perspective. And so what we have are a lot of exceptions. There are some limitations here. And so we have a lot of people right now focusing on how do I get myself out of this rule? How do I avoid this accelerating income recognition for me? And then 451C, these are rules related to advance payments. Advance payments are commonly called deferred revenue, unearned revenue, situations where we have collected cash for goods or services to be provided in the future. And 451C largely codifies the rule that existed previously under Revenue Procedure 2004-34, which provided a 1-year deferral, meaning if I collect the cash in 2020, I can recognize it in 2020 to the extent I've earned it or to the extent that it is recognized in my financial statements, and then the remainder of it needs to be deferred to the following year. So where we're focusing here, so for ASC 606, we're looking at any clients that are having changes made as a result of their book revenue recognition or book implementation of ASC 606. If book is changing and we can also change, we have a new 3115 filing obligation. We have to notify the IRS that we're changing our tax accounting method to match our new book method. If we are not going to be able to follow the book method, we have a new Schedule M adjustment. We need to understand how is that being computed, how is that being tracked, and how do we maintain this rolling forward. 451B, the good news is this is hitting the smallest number of our clients. This is only clients that have an audited financial statement or that are required to file financial statements with governments or other state agencies. So that unfortunately ropes in a number of banks. Even if they don't have audited financial statements, their FDIC and OCC filing requirements will throw them into this category and make them subject to Section 451B. But as I indicated, where we have a lot of clients spending time and energy right now is understanding those exceptions and trying to see if there is an argument that they can avoid the application of those rules. And then 451C, any client that has deferred revenue, unearned income, unearned revenue, any customer deposits, anything like that on their balance sheet, typically that will be a liability on the balance sheet. Anybody with those accounts needs to look at whether their current method complies with 451C. This is unfortunately a source of significant book tax nonconformity. Book will generally spread those payments across the entire period covered by the prepayment. We cannot do that for tax purposes. We have to make sure all of that income has come into income by the end of the year after we have collected it. And this takes us to our first polling question: which accounting method development impacted you the most? Bonus depreciation. That's probably accurate. We did have a lot of people take advantage of the small taxpayer safe harbors last year. Those were probably the two biggest ones that we've seen thus far, but revenue recognition I think is going to catch up by the end of this year. 163J, these are the interest expense deduction limitations that we have alluded to. And under 163J, the amount of deductible interest expense is limited to the sum of your interest income and 30% of your adjusted taxable income. There have been a lot of comments on these rules. These are complicated rules in a lot of regards. We received proposed guidance from the IRS, I believe it was November of 2018. They have completed a package of final regulations that have cleared White House or OIRA review and are sitting waiting to be released. I think the last I heard those were sitting around 400 or 500 pages. I don't recall the exact number. But they also have a set of proposed regulations that are going to address some of the issues not addressed in the prior regs. Those are currently under review by the executive branch, and hopefully those two will be released together within the next weeks/month. One of the big issues that people have complained about in the proposed regs was the broad definition of interest. This is not just your interest on car loans and bank loans. This is payments for the use of capital. This is debt issuance costs. There are all sorts of things included within that definition that taxpayers are concerned about. And the unofficial rumors are hopefully that definition is going to get narrowed in the final rules, but TBD on that. Additionally, so the adjusted taxable income limitation for interest expense is intended for at least the next few years to be an EBITDA number. So earnings before interest, taxes, depreciation, and amortization, meaning we take our taxable income and add back our depreciation. But in the proposed rules, there was a limit on the ability to add back depreciation if that depreciation was included in cost of sales. So manufacturers, miners, retailers who use a lot of assets in their inventory production businesses effectively lost the ability to add that depreciation back and had a much lower deduction or limitation than taxpayers in other industries. This has also been an extremely unpopular provision, many comment letters, and we have our fingers crossed that this is also going to get loosened in the final rule. Certain taxpayers are eligible to elect out of 163J, specifically real estate businesses and farming businesses. We have had a lot of people look at and make those elections, and a lot of people that we would not think of necessarily as in a core real estate business are looking at considering whether they can make that election. I know the long-term care industry, for example, is one of the industries that has commented on that. They would like to be included in that because they would like to make the election to avoid 163J and then give up some of their depreciation. And as Adam said, the computation of this limitation and how this carries forward into future years is a challenge. They are very complicated rules, especially for pass-through entities, and partnerships specifically have some very detailed rules on where that carry forward needs to occur, and then what information you might need from the partnership in order to understand how and when you might be able to take that carry forward into account. That's an issue people are really struggling with right now. We're hoping in the final guidance and in the new proposed guidance we'll get some clarity on that. The bonus depreciation rules, what does it mean for a taxpayer to have taken into account floor plan financing? We got a very favorable answer to that in the proposed bonus depreciation regs from last year, saying that floor plan financing is only taken into account if you used it to increase your interest deduction threshold above 30% of your adjusted taxable income. If you didn't, then you can have your interest deduction and your bonus depreciation. So that was a very favorable component of that. And then the small taxpayer exception. This, as I said, there have been some issues with understanding who does this apply to and how does this work. The planning opportunities, we're seeing people as we're starting to understand the rules, and when these rules get finalized, where we're seeing some activity is the exceptions and limitations on 163J apply at a trader business level. A trader business is defined for purposes of 446 in the accounting method speak. You can have multiple separate trades or businesses within the same tax return. So it's possible that you could arrange your operations so that you maximize your exempt operations that are exempt from 163J and try to minimize the impact of the deduction. And then restructuring is potentially an option. How the interest expense offsets itself in different entity structures using pass-through entities, consolidated groups, individual returns. There are very different answers to offset excess income on one versus excess expense on the other. And we have a lot of people looking into those rules. And then once we understand what is really considered interest, there may be a push to consider restructuring some of these arrangements to see if we can get these out of the scope of the interest expense deduction. With that, I'm going to turn it over to Adam.
We had a question from the audience, and this is a good question, Andrea, on 163J. Basically, if you get a K1 that has 163J information, are you bound to comply? So let's just say you're me, Adam Sweet, you don't have 25 million of gross receipts on your own return, but you get some K1 that has some 163J information on it. In fact, maybe even the interest expense was limited. Are you bound to comply with that, or how do you take that information into account on your own 1040? And I can even run with it. It's to Andrea's point, it's a trader business by trader business determination. So even if you're just, again, I use myself as an example, I do not have 25 million of gross receipts on my own tax return. So I would generally, qualify as a small taxpayer. But if I get a K1, and if the partnership itself is subject to 163J, then I am bound. For instance, if there was interest expense limited on the K1 from that partnership, then I can't use that interest expense until potentially a later year. So certainly pay attention. If you're getting K1s flowing through with various 163J items, definitely pay attention. And the other thing I would say is it can change year by year. So you could have gotten a K1 last year that had interest expense limited from a partnership, and circumstances change. For instance, maybe the partnership this year is no longer subject to 163J, and that could potentially free up the interest expense limitation. So I don't know, Andrea, anything else?
Yeah, and that's where just the structuring of operations comes in, because there are very specific rules, as Adam said, when you own an interest in a pass-through entity. If that particular activity had been engaged in directly on your tax return as a Schedule C or E or F business, you could end up with a very different answer than if that is coming to you from a partnership or an S corp. Similarly, for corporations, you get very different answers in the consolidated group setting versus separate return filing setting that need to be considered when you're deciding how best to avoid these limitations.
But good question, because that's a question that we faced a lot last year and we'll face again this year. So turning a little bit, then kind of shifting from the exciting world of 163J to opportunity zones. We thought we'd just spend a few minutes today clarifying what the opportunity zone program is and then kind of what we're seeing there. So the basic idea of the opportunity zone tax incentives, which were passed at the end of 2017 as part of tax reform, is that Congress is trying to encourage investment into quote unquote, disadvantaged areas of the country. And Congress is doing that by, if you have eligible capital gains, you can defer paying tax on those eligible capital gains by investing those gains into these designated areas that are called opportunity zones. Generally speaking, you have 180 days to make that investment. So if you sold stock or sold some property, generally speaking, the clock starts ticking. And if you wanted to defer those gains, then you would need to make your investment within 180 days. It's a heck of a lot more complicated. I'm going to give a very simple overview today. I just would say that it's a lot more complicated probably than a lot of people appreciate. Probably even I learn new things every day from the Opportunity Zone program. So I just encourage anyone, if they're interested in it, either reach out to their tax advisor or reach out to us. But with that being said, so the basic idea is, here's an example here of the tax benefits. As I mentioned, get qualified capital gain this year, you would get gain deferral if you made the investment. So the example I have is someone's got $1 million of eligible gain. You invest that. Another key point is you can't buy the property directly. If you're looking to make an investment into an opportunity zone, you actually have to make it through what's called a qualified opportunity zone fund, which could be a state law partnership LLC. And then the fund is the one that makes the acquisition. But assuming you do all that, 2020, you would defer tax on the $1 million of gain. If you hold your investment for 5 years, you get a free 10% step up. So you had a $0 of tax basis in 2020, you get a free $100,000 step up in 2025. 2026, this is a key point that a lot of people forget. I mean, notice at the beginning, I used the term deferral. It isn't permanent. The gain that you defer in 2020, you pick up in 2026 via operation of the statute. So you would pick up, you deferred $1 million, you had a $100,000 step up, so you'd pay tax on $900,000 of gain in 2026. If you hold your investment for 10 years, the real cherry on top, or the juice, or the real large tax benefit is, if you hold your investment for 10 years and you exit, all of the appreciation beyond your deferral can be tax-free. So in my example, if the taxpayers sold it for $2 million in 2030, so they had $1 million of depreciation, they can avoid all tax on that $1 million of depreciation. And that includes ordinary income recapture. So if they can even avoid depreciation recapture. So a very powerful tool if you pick the right investment and you can hold it for 10 years. Not permanent deferral, but the permanent gain exclusion would pencil out very nicely if you had the right investment. You can't, to have good property for an opportunity zone investment, you need either what's called original use, or you need to substantially improve existing property. And again, this needs to generally be property or a business located in an opportunity zone. Original use means you're buying land and building new, or you're constructing something new. And you need to purchase that after December 31st, 2017. Substantial improvement means you buy an existing structure, an existing building, an existing business. Again, you need to buy it after December 31st, 2017, but you make $1 of improvement to it for every $1 of cost that's allocated to the building, but you can exclude land from that. So I have a simple example below where if you spent 150 grand on land in the building, 50 grand is allocated to the land and 100 grand is allocated to the building. you'd need to make $100,000 of improvements to the building in order to satisfy the substantial improvement requirement under the opportunity zones. Generally, if you're making substantial improvements, you don't have to make those all at once. You generally have 30 months to make improvements. We have new or semi-new final regulations from the government. And what they told us is during that period that you're deemed to hold good property, during that 30-month period, even though you may not be, your improvements may not be complete. Key dates and timelines, I mentioned in the beginning, generally speaking, you need to make your investment within 180 days. There are special rules. If you're a partner in a partnership or you're a shareholder in an S corporation, there are special rules that you can use a couple of different dates. You can either, the partnership or the S corporation could make an investment. If it chooses not to, the owners, the partner or the S corporation shareholders, can either use that same 180-day date, or they can actually use a 180-day date that begins on the due date for the entity's tax return. And the idea there is that there may have been a sale transaction, maybe you're a partner in a partnership, maybe a sale transaction you weren't even aware of until you received the K-1 in the next year. So it's a very taxpayer-friendly rule that would say you can start your 180-day clock to defer that gain from the due date of the return, which would generally be March 15th of that next year for a calendar year entity. Some updates on what are called 1231 gains. 1231 gains are sale from the sale of property used in the trade or business. We see 1231 gains often in the real estate context. It's where we most often see those. There was some confusion last year, mainly on the part of the IRS, about how to treat 1231 gains. And the confusion is that net 1231 gains are typically capital gains, and net 1231 losses are typically ordinary losses. But the idea is you have to net those items together. And there was a rule from the IRS that said you'd have to wait until the end of the year. So even if I sold a building and generated 1231 gains, I'd have to wait until the end of the year to net all my 1231 items together before I can make a qualified investment. And that would be an issue. Let's just say that you have a fund that's looking to raise money, or let's just say I want to close on a piece of property sooner than that. Potentially you weren't able to do that because you didn't have qualified gains and you couldn't make a qualified investment. Fortunately, these final regulations that were released by the government a few months ago, no longer do you have to net. You can invest gross 1231 gains into a fund and into a qualified investment. So another very taxpayer-friendly rule, taxpayer-friendly development. Related party issues, this is probably one of the top 2 or 3 most common questions we get. We got last year and we continue to get now in the new filing season, is that the gist of it is, I own property in an opportunity zone. I didn't buy it recently. I've owned it for 10 years. I've owned it for 20 years. But I looked on a map, I see my properties in an opportunity zone, or I see my business is in an opportunity zone. What can I do? And unfortunately, there are not a lot of great options. I mean, first of all, there is no tax benefit. If you just own property in an opportunity zone and sell it, there is no tax benefit. The property may be worth more now to a buyer because the buyer may be able to make use of the opportunity zone provisions, but there's no real tax incentive to you. Further compounding it is that there's a set of rules that basically will stop you from selling. If you own existing property and you want to set up your own fund, there's some very stiff related party rules that make it difficult to sell a land to a fund that you own more than 20% of, because the land will be deemed to be bad property. And in fact, there's some ambiguity in the final regulations that would say even if you owned less than 20%, 20% is the related party threshold for opportunity zones, but even if you own less than 20%, that if you sold property to a fund and invested the gain into the fund, potentially the IRS would disregard the investment. So the workaround that we see in most cases, if taxpayers if they own property, own a business, they have qualified gains because they want to develop their property, the workaround is leasing. There are no related party prohibitions for leasing. So you could have a fund that you control and you could lease property if the property is in an opportunity zone to your fund. Now I'm simplifying here. There's some other requirements to meet, but that is the workaround. that if you own existing property and you want to make use of the program, you'll probably be exploring a lease. And that's what we're seeing in the last 3, 4, 5 months. Andrea mentioned the American Bar Association's tax section meeting. That's what they were talking about there too, that if you, because of the related party prohibition, that leasing really is the avenue to go down to potentially develop property that you own currently. So just, taking a step back, we're in February now, 2020, 2 years later. I think we still see lots of interest in the opportunity zone provisions. We still get, I receive lots of calls every day from clients and from my fellow partners interested in it. I think there's still a lot of people that maybe as they learn more, they take a step back for a second. And why is that? Well, first, you have to hold it for 10 years to get the full benefit. Secondly, the deferral is not permanent. You're going to still have to pay tax in 2026. It's also cumbersome because you can't just buy the property directly. You have to set up a fund structure. You're going to pay tax advisors and structuring experts to potentially get the result you want. And then also the political future. It's been much in the news the last 5, 6, 7 months. People, frankly, attacking the Opportunity Zone program. Politicians in DC, claiming that it's benefiting certain people, or maybe it's not achieving the intended results. So we are seeing people do it. I would definitely encourage people to reach out to us or to reach out to their advisor. But a certain percentage of people, as they learn more, they decide for a variety of reasons not to do it. And it is, are you considering an opportunity zone investment? Yes or no?
And Adam, it looks like we did get a question here.
Okay.
If the original gain was from the sale of property in the name of an individual and the gain is reinvested in the name of the individual single member LLC, will it qualify as the same taxpayer?
Yeah, generally yes, because a single member LLC is as long as it hasn't elected otherwise, would be disregarded for tax purposes. So that if the individual had stock they sold, they could make their investment into a fund through the single member LLC, and that would be viewed as the individual making the investment. We would ignore the existence of the single member LLC for tax purposes. And looks like the overwhelming majority of people are not considering an opportunity zone investment. So interesting. I'm going to skip ahead here too. We're running out of time, but I did want to hit one other point on opportunity zones. Just remember, if you live in a state with an income tax, don't forget about the state level. Not all states conform to the opportunity zone program. And the big example here is California does not conform. California has a maximum 13.3% rate on gains. So you could be doing everything right. You're going to defer your federal capital gains, but you're still going to have to pay California capital gains tax of 13.3%. So just don't leave that out of the equation. I think as federal tax practitioners, I oftentimes ignore states or don't think about states, but it could be a very material impact. Quickly as well, again, we're running out of time, but wanted just a quick update on the new Section 199A deduction. In my introduction, this was introduced to kind of equalize the tax treatment of pass-through businesses with the corporate tax rate. Corporate tax rate was dropped to 21%. 199A, Cap A, was introduced to kind of equalize the tax treatment for business owners that pay tax on their income on their own returns rather than the corporate level return. As mentioned, generally the deduction is determined at the individual level. It can drop your rate down to 29.6% if you're in the highest effective tax rates. I just emphasize this is not a 199A webinar here. There's numerous limitations. There's numerous definitions to consider. So please reach out to us or to your tax advisor if you have questions. We do have final regulations that have been in effect for over a year. But what are we seeing? What are still the big questions? Probably still the most common question we receive is the treatment of rental income. There's a lot of other businesses where it's a know it when you see it. Most of our operating businesses, our contractors, our construction companies, they're going to have qualified business income, and they're going to have enough wages, and they're going to have enough other things to claim the full deduction. So that's pretty straightforward. Where we get into a lot of gray area is rental income. And the problem is that rental income could be qualified business income and could be eligible for the 199A deduction, but it is not necessarily always going to be QBI. And there's a whole, we could spend another 30 minutes talking about why that is. There's 70 years of kind of disparate case law and confusing guidance from the IRS. The IRS did give us a revenue procedure last year to help determine whether rental income is qualified business income. You may see it in the news. There's references to 250 hours, to no triple net leases, and so forth. All I would say is that RevProc is just a safe harbor. If you don't meet the requirements of the safe harbor, that doesn't mean that you can't claim your rental income as QBI. It just means you have to look back to the existing case law, existing guidance from the IRS to see if you can get you there. So if you're hung up on, if you hear your tax advisor saying you need 250 hours or you can't have a triple net lease, that may be true, but it's not automatically true. And I will turn it over to Mel. Mel?
Thank you, Adam. And with that, I think that we will we'll go ahead and move now from, in the few minutes that we have left, from what's happened with regard to legislation that was enacted over 2 years ago to legislation that was enacted at the end of 2019. And I think the most important item there to focus on is probably the Congress, as usual, thinking that better late is better than never, did finally extend those provisions that had expired at the end of 2017 and 2018, and actually went ahead and tossed in those that were going to extend at the end of 2019. Now, virtually everything was extended retroactively and was extended through the end of 2020. There is one exception to that, which is some of the biofuel provisions were extended out through 2022. But generally, you're going to be looking at one more year of opportunity under these provisions. Now, we do have a somewhat detailed list of all of the provisions that were extended. We're going to make sure that that is available to everyone. And I would certainly urge you to go through the list, see if there's anything there that applies to you, see if there's anything there that applies to your clients. In particular, I would direct your attention to the 179D provision. This is the energy efficient commercial building provision. This is one where you actually have to do some additional work in order to qualify for the deduction. It is one where would specifically direct, as I say, your attention to 179 Cap D. As long as 179 Cap D, which is the energy efficient commercial building provision, gets you a deduction of $1.80 a square foot on buildings that meet certain standards. It requires a study, and as long as the provision was not in effect, lots of people didn't do studies. But now we have an opportunity to step back to do those studies and to get a benefit either in the 18, 19, or depending on when you place it in service, even the 2020 provision. If we can step now one slide ahead. The other piece of legislation was the Secure Act. This is primarily a combination of IRA and retirement plan enhancements, primarily offset by a rule designed to significantly reduce the benefits of the so-called stretch IRA. Now, the stretch IRA is where you have IRA funds that are then passed along from the deceased to a much younger heir. And under the old rules, you were able to distribute those over the life of the. Let's go ahead and move to the next slide if we can. You see the basic rule now is that those IRAs must be distributed over a period not to exceed 10 years. Note that this does not apply in the case of eligible designated beneficiaries, the most notable of which is the surviving spouse of the now deceased employee. So it's something that received a great deal of attention, but is not one that is going to perhaps have the full influence that some people originally felt that it might. Moving on to the next slide. There are other IRA provisions. These are positive provisions. The required minimum distribution has been advanced from the year in which you turn 70 and a half to the year in which you turn 72. And the age limitation that used to exist on contributions to a regular IRA has been completely eliminated. If you want to work till you're 90, you can continue to contribute until you're up to your IRA until you're 90, although you probably are going to have to start taking money out as well once you each reach age 72. Let's move to the next slide very quickly. I do want to point out, this is something that I believe we will see more attention to as the year goes on. This is a new provision which will allow multi-employer 401ks actually to be effective. And the goal here, of course, is to allow a cost sharing of the management of these, and hopefully make 401ks available for perhaps smaller or medium-sized businesses that previously felt the expense of having one was simply too high. Previously, you had to be a member of a controlled group in order to join in one of these. After the Secure Act, all unrelated members can join. Further, should anything go wrong, should any one of your members foot fault, for instance, the penalty is no longer the entire 401k is disqualified. The penalty is simply the business that foot faulted probably is not going to be allowed to stay in your 401k anymore. Moving on to, whoa, we're getting close to the end here. I'll try and keep rolling. Let's go back to 2017 and the Tax Cut and Jobs Act. In addition to being the most comprehensive rewrite, it also set new standards for last-minute inclusion of provisions that may well be best thought of as having been first drafts. The TCJA is generally thought to be the first major piece of tax legislation to include handwritten changes made on the Senate floor while the legislation was being considered, a copy of which you see on the slide in front of you. And as a result of this, we really should not be surprised that there were a few unintended results. One unintended result we see on the next slide was the kiddie tax. The TCJA did away with the kiddie tax and replaced it by taxing that type of income using the trust rates. This was not, it turns out, the best way to handle this. And the solution was Congress went back, undid the provision, and now the kiddie tax has been restored for 2020. And an election is now available for 2018 and 2019, either to use the kiddie tax or alternatively to use the trust rates that were provided. Let's take a look at our last slide. What does the future hold? Well, we're not quite sure what the future holds. Hopefully we will be getting a better sense as the year goes on. It's certainly going to be a difficult and politically treacherous year this year. I would not count on an enormous amount being enacted. We're going to reconvene the webcast on March 27th, and hopefully we will have more to tell you about what the future might hold with regard to tax legislation at that time. And with that, I think we have one last polling question that we need to have answered in order to get the CPE in. So what do you think? Will Congress pass major tax legislation in the next few years? Yes or no?
All right. Do we have any final comments?
Yeah, just wanted to, this is Adam, but just wanted to thank everyone for attending. We'll stick around for a few minutes. We don't have any open questions, but if anyone does have any other questions they wanted to run past us, we can stick around for a few minutes. Otherwise, everyone has a great day. And just, I would say that we have other webinars coming up. So please do attend. If you're interested, and then please reach out to your tax advisor or reach out to your Eide Bailly professional with any questions. With that, again, we'll stick around. I see we already have a couple questions coming in. We'll stick around to answer those, but otherwise, we'll let you guys go.
In regards to the polling questions, yes, we only did 3. No worries, it's totally fine. And the last question here is, do you expect any major tax legislation in the next few years?
I'm going to defer to Mel on that one.
You're turning the question back on us, huh? I thought who knows, right? Go ahead, Mel.
We sort of dodged here by saying the next few years. Yes, I think we do expect to see major tax legislation in the next few years. Maybe not on quite the level of what we saw in 2017. the big question is what could be in that tax legislation. And for that, I think much is going to depend upon who wins the elections in November of this year. But as I say, I hope that we will begin to see a better sense of where perhaps the Democrats are coming. We have been told that the Republicans are likely to advance some type of middle-class tax bill this summer. Whether that is enacted this year is open to question, but I think would give us a good look at what is likely to be considered going forward. Certainly, the question of whether or not the individual tax cuts from 2017 will be extended is very much on the table. Particularly if there continues to be a significant Republican presence, then I think that is something that I would certainly think has a significant chance of ultimately being enacted. Although I will point out that Congress rarely acts before it absolutely has to. So don't hold your breath on the extension of anything that does not expire for more than a couple of years in the future.
There was a question, Amy. Yeah, you saw that question just on the CPE in the slides.
Yes, the slides were emailed out yesterday afternoon. If you don't have them, I can resend them. And CPE will be issued within 10 to 15 days after this webcast via email.
Very good. So it looks like no other questions. So we'll let everyone go about their day, but please do reach out if you have questions. I think you have our contact information here to reach out to us directly, or again, reach out to your local Eide Bailly professional or your tax advisor. Again, thank you everyone for attending, and hopefully we will see you soon on our next webinar.
Awesome. Thank you all. Have a great day.